Assalamualaikum warahmatullahi wabarakatuh. Today our group will be presenting about SME financing and investment appraisal. And this is our group members.
My name is Nur Ifa Batrisha binti Johari.
My name is Nur Hatfina.
Hello, my name is Nurulina Nabila binti Jafar.
Hi, my name is Adam Denis bin Badrin.
Hi, my name is Nur Izzati Betin Rahim.
There are multiple financing needs needed to be addressed in the Malaysian SMEs according to the article that we have chosen, and it mostly depends on the business cycle it's currently in. In this case, I chose during the startup phase. Financial support is often highlighted as a primary strategy that is heavily required during a firm initial phase, as it's crucial to get a funding in order to get a firm running. Financing is needed in order to help SMEs emphasize and develop high-quality products and services to ensure survival in dynamic market. Financing can be one of the most difficult problems to overcome. Global lack of access to credit is cited as the most consistent and discussed challenge for SMEs, whether globally or in Malaysia. The issue is also intensified by risk aversion by lenders, since banks often perceive SMEs as having a higher level of risk and weak expected returns. This leads them to favor a safer borrower like a larger corporations. In order to overcome these issues, SMEs need to have a strategy in order to survive. For instance, the development of skills. SMEs owners are encouraged to develop strategic financial management skills and management capabilities. This helps them to have a better management of the existing funds, and with this, it also enables them to be able to convince banks to get more funds. Authorities like SME Corp suggest a phased approach by prioritizing financial support during the startup phase, and only then they could start focusing on management and marketing in the growth phase. The article mentions several ways in which Malaysian SMEs can do in order to seek more funds. For example, through capital markets, sources like equity sales. They also can apply for government assistance or assistance programs. There are tons of specialized government funds, support programs, and private assistance programs that are specifically inclusive to lower entry barrier for new Malaysian SMEs.
Part A, initial outlay. The purchase price will add shipping costs and professional installation costs to get depreciable value, which is 930,000, and then they will add increase in inventory and less increase in trade payable to get total outflow 960,000, and then they will less total inflow, which is 189,600 to get net initial outlay 770,400. On the same slide, they are working off disposal of old machine to determine what is the type of the tax of the company. Then the cost will less accumulated depreciation to get carrying value, and then they will be compared with a sales proceed to get deficit 40,000. This determine the company is tax savings. Part A, annual incremental cash flow. The years will be divided into 3 parts, which is 1 to 2 years, 3 years, and 4 to 5 years. Savings income like increase in sales or decrease in expense will be less with cost and expense like operating expense and maintenance and labor. Then they will get net profit before tax, and then they will be multiplied with tax percent, which is 24%, excluding for 4 to 5 years part because the net profit before tax is negative. Then for the all of the years will be get net profit after tax, then they will be add back the depreciation to get after tax annual cash flow, which is 1 to 2 years is 257,800, and for year 3 is 231,200, and for the 4 to 5 years is 124,800. Now is for terminal cash flow. Salvage value of new asset 50,000 will add increase in inventory 50,000 and less increase in trade payable 20,000, and the result of terminal cash flow will be 80,000.
For your first investment appraisal technique, the payback period. To find the payback period, we use the formula where the cash flow is uneven. So for year X is the year 3 because cumulative cash flow on year 3 does not exceed the initial outlay. Then Plus with the initial outlay amounted 770,400 minus with 746,800, which is the accumulated cash flow until year 3 divided by the cash flow after year 3, which is 124,800. Then we will get the payback period 3.19 years. Hence, the result is GTL should replace the existing tanning machine since the payback period is 3.19 years, which does not exceed the desired period, which is 5 years. Second, the net present value. Since the interest rate is 16%, we will use the PDIF of 16% and refer to the table to find the amount of PDIF. Then we will multiply the cash flow with the PDIF amount to get the present value for each year. Then we will combine all the present value from year 1 to year 5, then got RM 729,408 and minus it with the initial outlay 707,400. Then we will get the result of negative net present value amounted negative RM 41,992. In conclusion, the GTL should not replace the existing tanning machine because the net present value is negative. For the instant rate of return, we need to identify the new higher discount rate in order to get a new positive net present value. So, after some tests, we found that 12% will be the new interest rate to get the positive net present value, which is RM 25,390 ringgit. Now, we will imply it to the formula, which is firstly 25,390 divided with the 25,390 plus with the 41,992 and multiply it with 4%. Then lastly, plus with 12%. So, for the IRR, we will get 19.51%, which means GTL should not replace the existing tanning machine because the internal rate of return is less than the firm's required rate of return, which is 16%. Lastly, the profitability index. To find the profitability index, firstly, the NPV amounting negative RM 41,992 divided with the initial outlay 770,200 and plus with 1, and we will get profitability index of 0.95. Hence, GTL should not replace the existing tanning machine because the profitability index is less than 1.
Part B, Question C, Evaluation of Investment Appraisal Result. Interpret the result obtained from each investment appraisal technique. Firstly, the payback period is 3 years, which is lower than the maximum desired period of 5 years. That means the project is given a quick recovery of the initial outlay for the machinery. Secondly, the net present value NPV has negative value, which is 41,992 ringgit. That means the project has failed to gain the minimum required rate of return. Thirdly, the internal rate of return IRR is 13.51%, which is lower than the firm's required rate of 16%. That means the project does not generate sufficient funds to compensate for its cost and risks. Lastly, the profitability index is 0.95, which less than 1. That means the project is expected to destroy the value of the machine rather than increase the value for the investment of the machine. Next, in your discussion, explain why a project may show a favorable IRR and a short payback period but still produce a negative NPV. The IRR shows favorable value, but NPV is still negative because IRR only measures the rate of return, but not the actual amount of value created. Therefore, payback period is shorter but NPV is negative, which means the payback period ignores the time's value of the money, since it only measures the payback period by using the current cash flow only, and ignores the cash flow after the payback period is counted. Hence, this is why NPV is still negative, even though the IRR and the payback period gave the favorable value for the project?
Here is a deep part of this question, capital rationing decisions. Company has a capital budget limit to 1,200,000 to do a project. They have a 3 project. For the first is Ecotunnel 8,000. For the second is Project Alpha Solar Farm, and for the third is Project Beta Water Recycling. We use probability index to determine the ranking of this project. So the formula of PI is 1 plus NPV divide investments. After ranking, we can see that the Project Alpha Solar Farm is the number 1, and Project Beta Water Recycling is number 2, and Project Ecotunnel 8,000 is number 3. To maximize shareholder weight, company will invest mix between projects. That means company will invest 100% in Project Alpha Solar Farm and part of Project Beta Water Recycling, and the NPV after calculation is 290,000.
No, the board of directors should not rely solely on net present value when making the final investment decision. Although MPV is the most reliable technique compared to other investment appraisal techniques, MPV has its own disadvantages such as time-consuming problems and requires long-term forecast and discount rate estimation. Moreover, relying solely on MPV is an outdated and insufficient approach. The estimated loss in shareholder wealth means that the company earns negative NPV, which shows that the expected rate of return will fall short of it when replacing its outdated machine. However, the long-term governance, sustainability, and operational risk of continuing to use the outdated machine should also be taken into consideration. BOD should consider for the replacement of the existing machine if the new machine will give the benefit to the company in the future, such as ability for the machine support the process of the operational while giving the benefit to the environment, the lower cost taken in maintaining and repairing, higher productivity, and better quality production compared to the outdated machine. As a public listed company on Bursa Malaysia, green tech leader Berhad must pay attention to the ESG, which is environmental, social, and governance commitments in the use of the new machine. In the aspect of environmental, the company needs to seek an equilibrium between economic objectives and environmental considerations while making decisions to replace the existing machine. The new machine, which is Ecotunnel 8,000, must be less polluted, have good waste management, and energy efficiency. Besides that, in the aspect of social, the company needs to utilize local resources and strengthen employees, suppliers, customers, and communities. The new machine must be safe and healthy to the workers while using it. No forced labor occur, and build trust to the customers and local communities towards the company. Lastly, in the aspect of governance, the company needs to implement the best practices governance principles by ensuring that the new machine will give the benefit to the company for the long term. By implementing these factors, the company not only maximizes the profit but also attracts the shareholders to invest in the company. That's all from us. Thank you.